You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is, of course, the program for you, the basic retail options trader who wants to learn more about options, how to use them, how to incorporate them into your portfolio, as well as some of the tips and tricks we can pass along to you, some mistakes you may want to avoid, all sorts of fun stuff here on the program. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-compelling, ever-exciting Options Insider Radio Network. And if you're one of those people out there who's just been caught up in all the Flash Boys hysteria, you want to know more about how the HFT impacts your trading, as well as if what they say is true, is that the markets are rigged against you, well, then check out the latest addition to our network, Trading Tech Talk. All sorts of cool stuff on that show, including the most recent episode, which is going up as we speak right now, all about the Flash Boys. We debate that book. It's really interesting stuff. Check it out. I think you're going to like it. You can, of course, find it wherever you find the Options Insider Radio Network programming, including theoptionsinsider.com, Stitcher, iTunes, Indeed, along with our mobile app. Of course, if you haven't checked that out by now, surf on over to iTunes or Google Play or the Amazon App Store. Check out the Options Insider Radio Network mobile app. You can stream all of your favorite episodes of Options Bootcamp, as well as Trading Tech Talk and every other program on the network. You can download them for offline listening, and as a lot of you did today, you can hit that contact button and send us your immediate questions, your immediate comments, your immediate feedback right to the host of the show. It's really pretty cool. Check it out. The Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me on the old drill instructor squad, we are short one drill instructor, but we are long on all sorts of great content. And joining me for this episode, as usual, is Mr. John Critchley, the options major domo over there at sogotrade.com. Mr. Critchley, welcome back to the program, sir.
Howdy, folks. Super duper to be back. I just came back from vacation just for this show, and I am excited to do so, and I'm looking forward to it.
That shows how committed you are. You come all the way back from Puerto Rico just to sit down with our Options Bootcamp listeners. Very dedicated of you, sir.
Kind of guy I am.
All right, and with the gang all assembled, we're going to dive right on into a very special segment this episode because we have so much listener mail coming in. We want to make sure we get a chance to really get to all of it. We're going to have a special mail Call-A-Palooza, and we're going to dive into it right now.
Mail call. Time to look at questions submitted by our listeners.
All right, and if you weren't in the mood for 4th of July, I'm sure that that bumper will do it for you. This is, of course, the mail call segment, the portion of the show where you guys get a chance to join us here on the old Options Bootcamp Drill Instructor Squad and make your questions and comments known. Like I said, we have so many questions and comments coming from a variety of sources, including the app. I want to make sure we give all you guys chances to air your questions, your comments, your concerns, your grievances here on the old program. And some great stuff coming in, John. I'm really excited to dive into this. Starting off with a question here. This one comes in from David Medley. And David writes, and this is actually an interesting one, John. It's not something I ever really thought about for this show. I never really planned to discuss it, but yet it is an interesting question. You know, we aim this show obviously at basic retail customers, but people listen to shows like this, they trade with great tools, and they become more sophisticated, and then they ask questions just like this. I've listened to about half of the 40-plus episodes. I don't recall hearing anything about how to get started professionally. I'm a 38-year-old software developer looking to change industries. The positions that seem to be open to me are commission only and require a significant cash, quote, capital contribution. I'm actually okay with this. Some positions have hefty training and or desk fees, which seems a bit scammy to me. Either way, it's not something I want to go into blind. If you covered this, I'd love to read or listen to it. Thanks, David. Well, David, it's a good question, and it's an interesting one because you're right. The traditional path that someone like you would have taken a decade or so ago is certainly the path that I took, that John took, that Dan, if he was here, he took as well, which was you come out to Chicago, maybe you go over to New York, and you essentially apprentice with a market making or a trading firm. They agree to take you in, they pay you, but they really put you as a clerk and they train you up in the business. You learn risk management really the best way you possibly can, which is to have positions thrown at you all day long, and then you learn how to manage them. It's like immersion therapy for learning a language. But that path really is pretty much gone now. You can't really come to Chicago and dive in and be trained up. There are still a few shops that may do that, but there are fewer and farther between these days. And also at the same time, remember, you're kind of coming into it at a weird time where there are a lot of professional floor traders and market makers who have left the floor or moved on, or their prop shops have closed. So you have a huge ecosystem out here in Chicago and in New York and other major financial centers of people who have professional derivatives experience who would be competing for jobs like this. You have a long road in terms of competition. You have a lot of people out there really who could take those jobs if they were available. So it's difficult for you, a relatively self-taught retail trader, to come to a firm like that and say, hey, take me on. That said, I would encourage you, if you take nothing else away from this conversation today, stay away from those firms that offer what you call the significant cash capital contribution. Essentially, they want you to come in and give them a bunch of money, and then they give you a draw against that money, and they will quote-unquote back you. They will leverage that money you give them to trade. And they may give you a couple of tools, but that's really about it. These kind of chop shops have been around forever. I remember looking at them before I came out to Chicago, back in New York and other areas. It's a scam, you're right, and it's been around for a while. And there still are a few out there preying on people who really want to get into this business, and they don't mind just throwing capital against the wall to do it. So I would definitely encourage you to stay away from that. So of course that limits your options then. You could still try to find a few firms who have, I'm assuming your focus is on options because you're writing to a show like this. If you still want to reach out to some of the bigger firms like the CTCs or the Wolverines and see if they will indeed bring you into their training program, that could potentially still be an option. They may like the fact that you don't come to the gate with any preconceived notions that they have to dispel you of. That could be a plus in your favor. But in general, right now, the path for someone like you is really to manage your own money, build up a successful track record, and then slowly over time, maybe you talk to friends and family, say, hey, I'm doing this. These are my strategies. Here's what I'm doing. Here's my risk management strategy. And maybe you get some friends and family to invest a little bit of money with you, and you build up a little small fund. And the key is to have a track record, a track record of not just successful returns, but of successful risk management. You don't want to lose money, and you don't want to go out there blindly swinging for the fences either. You want to implement a lot of the strategies we talked about on this show to really properly manage your risk. And then from there, once you've kind of got that track record going, you can dive into the fray with a lot of other guys to try to go out and get AUM, assets under management. Now, I warn you again, this is another difficult, very, very crowded area. You have a lot of professional traders, a lot of significant experience, and probably longer track records than you out there trying to compete to get AUM from a variety of different investors. Could be big banks, could be other funds who invest in hedge funds, could be large individual investors, whatever the case may be. That battle for AUM is a very difficult one, particularly if you implement options, because you scare the hell out of most big investors and pension funds and other sources of capital out there. So you really need a long track record, 15 years or more, to start getting any real substantial AUM if you want to implement options. So I hate to discourage you or dissuade you, but it is a difficult road that you're choosing for yourself, particularly now. John, do you have anything maybe perhaps a little bit more optimistic to share with our friend here, David?
I mean, I think that you were hitting on, just right in the head. You want to have your own track record. You want to just, firms like Sogo Trade and other firms, they offer reasonable commissions, and trade your own money, implement your strategies, get some kind of track record for a few years, and then try to, get your friends or family. Used to have, not anymore, but I used to have people come to me all the time back in the good old days and say, how can I give you money? I'll give you money, and then can I get a piece of you? But that's kind of changed, as Mark says. We have all these displaced traders, and it's much more difficult. But, build up your own track record. Maybe you can manage some family money or friends' money, and to try to go into one of these firms. Maybe First New York is one of the firms out there that you can look into. There are other ones, but just be really careful with capital contribution. That would make me, very, very nervous.
I guess the optimistic tone I could leave you with there, David, is that while on the one hand, this is probably the most difficult time to ever explore that path because most of the traditional entryways to that career are gone or vanishing. But on the other hand, what you're doing right now, being the at-home retail investor / trader, there has never been a better time to be you, to be that. The tools at your disposal are professional grade. In fact, you may have this strange notion in your head that if you came to a Chicago prop shop, for example, you're going to get all sorts of cool tools and cool tech and everything else to really be out there and compete with the big boys. And I'm here to dissuade you of that notion right now. I still know a lot of guys who are still active in the prop shop scene here, and these guys, they'll get a deal. Maybe they get 50-50, maybe they get 60-40. Not giving their own capital, mind you. That's 60-40 of the backer's money, or 50-50, whatever the split may be. And then they're essentially given a data feed and a seat at a desk and told, go forth and make money. They don't really get a lot of cool tools. In fact, a lot of them will go out and buy off-the-shelf retail products like LiveVol and other things we've talked about here on the show in order to give them some sort of market data, a little bit of analysis. And so they end up having an array of screens next to them with off-the-shelf tools that they're buying themselves. And the good news is you can buy those too. You can go out and buy LiveVol. You can set up a lot of other tools. You can, of course, work with your broker, whether it's Sogo or others, to really access a lot of great professional high-end tools that give you a lot of weapons that you didn't have a decade ago. So while the path may be a little bit more difficult, the tools and the resources at your disposal, the margin treatment, everything else, is light years ahead of where it was. So in that sense, you actually do have an advantage. And so that is probably a good thing. I don't want to completely dissuade you. And if you can, indeed, build up that track record. I know it's not what you want to hear. You want to hear that you can go out and call X person right now and you become a professional options trader. That's really not how it works anymore. Anyway, we can go on for this for quite a while. I want to make sure we get some other questions in too. But David, great question. One I never anticipated answering on this show, but I'm glad you wrote in. And then we wish you luck. Let us know how your story unfolds. I'm sure we're all very curious here on the old drill instructor squad. All right, moving on to the next question here, a more traditional question. This comes from Jay. He writes, "Hi, Mark. Options Bootcamp is a phenomenal program. I have learned so much, it's unbelievable." Well, thank you, Jay. I'm glad you're learning. That's the whole point of the show. That's the reason that we do this. Jay goes on to say, "I do still have one question, and it stems from the fact that I am not a convert from the equity world. I am new to the investing world, but I could never wrap my head around equity trading because it seemed too haphazard. It wasn't until I learned about the flexibility of options that I really thought I had found something worth sinking my teeth into." Well, I think you have a lot in common with just about everyone else here on this program, at least. Jay. He goes on to write, "So with that being said, How do you pick your underlying stocks? Is there a set of criteria you screen for among all of the optionable underlyings, or is it better to really start learning about a few select stocks and then just applying a specific strategy towards the stock situation as you see fit? So far, I've just been using SPY as a starting ground, but would like to move toward specific positions to play on the higher fluctuations in vol, inverse skew events, earnings reports, and such. Thanks again for all of your work, and please send a high five to Dan. He is my favorite drill instructor. Jay, well, I don't know. You give a shout out to Dan, well, then I might have to just cut that question off. No, I'm just kidding. There's no accounting for taste, is there, John?
Yeah, I think we have one of Dan's cousins running.
Yeah, I think it's Dan's brother.
I thought we had a little screen out. I don't know what happened.
What
there.
would you say to our friend here, Jay, John?
What I would say is that, as Mark mentioned in the last answer, most firms, including Sogo Trade, have the tools. We have a new advanced screener that gives you, that I actually use, that gives you bullish and bearish picks. It combines some of the fundamentals, which I like. I'm a fundamental guy, with the technical analysis, and by some algorithm that we have, it spits out these bullish and bearish stocks. And then from these picks, you can use any one of your strategies that you like. If it gives you bullish, then you can, do this trade, or you can do that strategy. And the good thing about this screener or other screeners is that it gives you a stop loss, it gives you an expected move, it gives you a time frame, and the track record's pretty good. It's not 100%, nothing is, but the track record's pretty good. And if you go to Sogo Trade, you can sign up, and it's a free 21-day trial. Most of the best clients that we have here, answering one of your other questions, are customers that started out small, went step by step. They start with one strategy and that worked, and then say, well, let me expand it. And if you listen to our podcast, all the ones we've done, we've kind of gone through that progression for you. So, learn trade by trade and find out which one works for you. And let me go on the earnings events. The earnings events that you mentioned, those are my favorite trades. And what I do, and I think I've mentioned this in the past, is that if Apple has earnings coming out, I look at the at-the-money front month or straddle, and that will give you what the market makers are perceiving, or the marketplace, as the move in the stock. And then I'll take that, and let's say it's 10%. And if it's a $100 stock, it's 90 to 110. I'll go to those strikes, and around those strikes, do a butterfly or some condor, or write a credit spread, or do something around those strikes. So I'd like to play earnings because it's action. It gives something to look forward to and follow. And but I will warn against this, and we've mentioned this in the past also. Be careful with earnings or big events, buying very far out of the money options, because you can be dead right, and the stock can move a lot, but it does move just enough, and you could still be a loser. So just be careful with that. So there's a lot of questions there, and I hope I answered most of them.
Yeah, you pose a lot of interesting questions there, Jay, and I'm not a big underlying guy, but I see what you're getting at from here, that how do we choose the underlying that we then trade options on? And it really depends on the strategy that you're looking for. You outline quite a few here, and you're lucky. As John mentioned, Sogo Trade and a lot of other brokers, and indeed a lot of other vendors out there, make a lot of great scanning platforms. I use a lot of them, Sogo Trade and others, to really do a lot of my trades. I also have mentioned LiveVol a few times on the show. I'll give them another plug. They have some scanners built in, a lot of good scanners. You can, of course, configure your own on a lot of these tools as well, and they have a variety of ones. They can, exploding implied volatility and things like that, which is exactly what you're talking about. You're looking for names that have a high fluctuation in vol. You can easily find those names, which, again, be cautious if they're big changes involved. Something is afoot in that underlying, so don't just go out and just blast out a bunch of premium willy-nilly. Make sure you really know what you're getting into in those names. Interesting one about inverse skew events. I'm trying to think of any scanner that could highlight that for you, and it really, you might have to make your own custom scanner for that, where you could compare maybe at the money implied vol versus, let's say, the 25 delta call implied vol, and try to figure out some level that is normal for the underlying, or some percentage you want, and then scan for that. That might be the only way to really find that, probably making your own custom scanner. But that said, again, the type of underlying we're looking for, the type of criteria really depends on the strategy. If you're looking to go out there and harvest premium, you obviously want a higher volatility name. You want something that's going to return and reward that strategy. So then the increasing vol, the big changes in vol are probably ones you want to look at. For the inverse skew, you're going to look for earnings events. That's typically where those types of patterns emerge. You can pay attention for those, maybe scan for earnings dates and find those. And I agree with John. I think sounds like you're still kind of cutting your teeth from an options perspective. So wrap your head around a couple of basic strategies first and see how they play out. Maybe you paper trade them. I know Sogo Trade offers paper trading. Most brokers do now. It's a way to test the waters without actually putting any capital at risk. And when you feel comfortable doing that, maybe you expand to some of the criteria, some of the names that you've scanned for. And so again, it's kind of hard to give you this catch-all answer because there's so many different ways to do it. But again, I think you're best off going to your brokerage firm, looking at the scanners they have already available for you, and then choosing from amongst those, change and vol, things like that. And then maybe you can configure a few custom ones of your own, like things for inverse skew, and you could set those up to cater to whatever strategies you're starting off with. Again, keep it simple first. You can't go wrong with some very simple, basic risk mitigated strategies, some verticals, things like that. Test the waters, cut your teeth first, and when you feel a little more comfortable, then you jump up to some of the more elaborate things like the diagonals and the time spreads and things like that. So great question there, Mr. J. Next up, we have a question from Ted Schwartz. He writes, "Hi." Oh, hello, Ted. "I'm working my way through the Options Bootcamp, learning lots of good stuff." Well, I'm glad to hear it. Again, a lot of you guys getting a lot of value out of the show. That's what we love to hear. He goes on to write, "I was wondering what kind of option strategies exist to hedge my 401k mutual fund gains. Would it be practical to use protective puts on some indexes, etc., to offset my risk of fund losses? Thanks." This is a very frequent question, comes into a lot of our programs on the network because a lot of you are in this exact scenario. You have some sort of 401k defined contribution plan with your employer. They usually put you in a handful of pretty broad, pretty vague funds like Fidelity and Vanguard and others, and you're limited. You're right. From a protection option, you can't go in and use options in that account. So you kind of left watching it and saying either I go to cash or I stay long this thing and have all sorts of downside exposure. So a lot of people have come to the same conclusion that you are, that it's worth their while to maybe set up a separate account. It's very easy to do now. A lot of brokers just set this up and set it up for the purposes of exactly what you're talking about, hedging. Now, it's going to take a little bit of work on your part. You don't mention what funds you have here specifically, so we can't help you with that. But you have to look at the funds you have. And a lot of the funds and their prospectuses, and you can find it online as well, they should have the beta, should have the exposure and the correlation to the broad markets. It depends what fund you're in, what index it will be most closely associated to. Obviously, it's a big broad market fund, probably the S&Ps. If it's more tech-heavy, NASDAQ, small caps, Russell, things like that. So determine, obviously, which index makes the most sense, is most closely correlated to the fund that you have, and then work out via that correlation how many approximate shares of that underlying you actually have, and it is equivalent to your fund position. And once you have that, maybe you have 500 shares of that underlying, whatever the case may be. Once you have that number, then you can proceed to go about hedging. And then it's up to you what you want to hedge. Obviously, we talked about before about buying protective puts here on this show. There's a lot of ways you can go about that. You can spend a lot of money. You can spend it a little bit more intelligently. We obviously opt for the latter here. We tend to probably recommend somewhere in the 3-month or so time horizon. It seems to be the sweet spot for protection versus paying too much from a time and carrying cost perspective. That said, you can also mitigate some of your premium by doing things like perhaps you only want to really protect against the gains that you made in that portfolio. So you buy a put spread versus just a naked put outright. That will mitigate some of your premium outlay. If that fund takes a huge dive, you're not going to protect against all of it. You're just going to protect your gains. But that said, I'd imagine if the fund retraces all the way back and you pretty much go back to ground zero with that fund from a break-even perspective, you're probably going to want to liquidate that and move into something else anyway. So if you have that mindset and you want to save a little bit of money, that's one way you could do it. Some of the other strategies we mentioned on this show in the past, like the collar, that gets a little bit more difficult because now you're talking a naked leg in this account. Remember, everything we're talking about here is in a separate account, so you're not going to get any sort of offsetting benefits, no beneficial margin treatment, nothing. This is essentially going to be all naked positions from the broker's perspective. So if you're writing this covered call, even though it's technically covered against these shares of a fund you have in some other brokerage account, this broker's not going to know it. Even if you do it with the same brokerage house, even if you do it at Fidelity or what have you, they're still not going to treat it as covered. So you're not going to get any sort of offsetting position. So you're going to tie up a lot of capital if you start doing some of the things we've recommended in the past, like writing a covered call to offset the price of that put. So you're probably better off doing things like put spreads, having no naked short legs, because you don't tie up a lot of capital doing that. But if you can handle those basic calculations, then this is a good road for you. John, I'd imagine you probably get this question a couple times a month. What do you usually tell people like Ted here?
I mean, I usually go, and we've again mentioned this in the past, is that, you should always allocate a small percentage, 1 to 4%, or in my case, might be higher. I'm buying some downside protection. Again, the 3 to 6 month period. And the one thing I will say is stay away from any leverage or inverse funds or anything that you don't really understand. I mean, that's the basic, these leverage or inverse funds, they really underperform, and they have been highly criticized, rightfully so. So, again, use the protection, buy some downside puts, but stay away from anything that you're not familiar with and you're not aware of. Just be very careful of these funds that come out saying, well, inverse leverage and all these fancy terms, because the math behind it and the studies that have been shown that these funds, they outperform or don't perform as expected.
All right. Dan couldn't make it on the show today, but he forwarded a couple interesting questions he received, as well as some comments like this one, which I don't have the name of the person, but Dan forwarded this on, so I want to make sure I read it out. This person writes, I'm really glad that you participated in the Options Bootcamp podcast and that I was fortunate enough to find it. Please convey my gratitude to Mark, who has no idea who I am, when you get a chance. And again, we get a lot of these. I don't like to read them all on the show because I don't want to turn it into some sort of self-congratulation fest. We appreciate you guys really liking the show. Again, you guys are the reason that we do it. So if you're getting some value out of the show, we're really happy that you are. And if you have questions or comments as a result of that, let us know. We love to hear them. Like this next question coming in from David Moore. He writes, hey, listening to your show has really helped me grow in my options knowledge. 2 questions. 1, do you have a platform you recommend? Well, I think you can guess what we do from who we work with the show on. But number 2, he writes, I'm currently with a certain broker. I won't name the name. I did some long calls last year and lost some money. I realized I needed to learn more, so I stopped and started reading. Now I'm ready to start trading spreads and selling premium. But my broker won't clear me for that level of options trading because I've not been trading live. Is it time to find another broker, or do I need to trade according to their rules until they clear me for more advanced options? Thanks, David. Well, the platform one's pretty easy. Obviously, we work with John. We work with Sogo. We like what they have to offer, especially if you're looking to execute some specifically defined trades and you want to maybe save a little bit on the commissions. That's a good way to go. So I'd certainly encourage you to check out them, sogotrade.com. If you haven't already, I'm assuming if you listen to this show, you probably kicked those tires already. But the second part of the question I think is really interesting, John. We, of course, have extolled the virtues on this program many times of paper trading. I just did it a few minutes ago. But it raises an interesting question, and maybe you can answer this, John, as how the brokers treat that experience in the paper trading. If someone comes to Sogo, for example, and they start paper trading a little bit, and they start paper trading more, and they start doing bigger positions, when they turn around and try to get qualified for options, do you guys take that paper trading into consideration, or are you like this broker? Then they need to have some skin in the game first before you really approve them for higher level options trading?
Yeah, this is actually a very tricky question, and questions that we've batted around with compliance. And what we do is we ask the number of years experience trading options, and we don't make any distinction between paper trading or real trading. We don't have that anywhere on disclosure. Now, and the way we view it is that we always tell our customers, and I always specifically tell our customers when they're looking to upgrade, when we ask these questions, you be honest, because it's a disservice to yourself and to us if you exaggerate experience. So if a customer is honest and they did paper trading and they were honest with that paper trading, we consider that experience. Now, all these firms have very strict rules. There's a big push from the regulators to know your customer rules. And we here at Sogo Trade, we review every account. We have like a big spreadsheet. We have all different qualifications. I will say that for level 1 or 2, that's covered calls and buying puts, buying calls. And the qualifications there are very minimal. For level 3, which is spreads, we usually require 1 year. For level 4 or higher, we acquire, which is naked options, at least 1 year, and you have to have 5,000 in your account, which is a very reasonable number. Some firms are 25,000, so we're reasonable there. And you also need to have some reasonable income levels. So, just be aware that these brokers, when they're denying you different levels, they're doing it to protect the customer and to protect themselves. But we're very, as a trader, I'll speak for myself, I'm usually very flexible in granting the highest level I possibly can under our rules. If this customer wants to shoot me, or any of our customers, shoot me an email at jcritchley, CRITCHLEY, at SogoTrade.com, and I can personally review your account and mention the show and get some free trades or whatever, and we'll see what we can do. But we have to follow these rules because the regulators come in and they'll pick out like 100, 200 accounts, and they'll audit them, and they'll say, why is this customer with no experience with $200 in his account level 5? And then if that was the case, we would get in trouble, we get sanctioned. So there are rules that we follow, but we do our best to do the most appropriate for every customer.
Well, there you go, listeners. If you were concerned if your paper trading experience counts, well, then you should be calling John over at SogoTrade, because they will take that experience into consideration. So interesting stuff. Thank you for that, John. And hopefully that answers your question there, David. All right, next up, we have a question from Mark Radcliffe. He writes, hello, Mark, John, and Dan. Thanks for providing your excellent options bootcamp program. It has done a lot to get me started with trading options. I split my investing between long-term buy and hold for retirement, short-term stock trading for side income, and am now adding options. My question is about selling calls to simulate a dividend on buy and hold stocks in my retirement account. The recommendation is to sell front month or even weekly in-the-money calls to collect the time decay. The problem I see is that these near-term options are extremely cheap. For example, Starbucks is currently trading around $72, and next week's 73 strike call ask is 26 cents. Does this not mean that if I wrote a single call and it expired worthless, I would make $26, assuming no changes? Once you take away the cost of the trade itself, you might make pennies or even go backwards on these trades unless you have many lots of that stock in your account. Am I reading this correctly? If so, do you think that in order for call writing to really generate any real income, you would need to hold several hundred shares of any one stock in your account? Thanks, Mark R. Well, the short answer to your question is yes. You are reading that correctly, and yes, you do need multiple contracts. For example, remember we talked about multipliers on this show in the past. The multiplier for equity options and most index options is 100. So if you're pricing up the price of a single one contract of an option, just multiply the price by 100. In this case, it's 26 cents, which worked out to $26 if you sold a one lot of those calls. And now, as you rightfully point out, you see some of the problems with just doing a one lot. You have ticket charges in the options world. You have per contract fees, other things like that. And that ticket charge, it's probably going to require a couple of contracts to make it worth your while to get in and out of these ticket charges on a regular basis. So that is one of the reasons, ironically, that they created the minis, to make that a little bit easier. But the problem with that is that a lot of brokers still charge that full ticket charge. So it makes it difficult to do the minis on 100 shares as well. So moral of the story, if you're writing calls and you want to really make it worth your while, you probably need more than just 100 shares in your account. You probably want to do 5 lots, 10 lots to start getting enough income coming in to offset those commissions that you're paying. And then it really is worth your while. Otherwise, if you're just doing a one lot and collecting $26, by the time you're done with commissions, you're effectively at that point pretty much just working a limit sell order. You're not really getting paid much to do it. So that's pretty much the moral of the story. Anything you want to add, Mr. Critchley?
I just wanted to add that it's just a percentage of, it's only $26, but it's a percentage of the stock that you own. So it's all in relative terms. That might not, if you did that every week, it may start adding up. But you're right about the commissions. They start to eat away at the cost. And the minis were, again, created for that reason, but they've been they've kind of been a bust. And so we'll see what happens. But there's no way around it. If you only have 100 shares and you're selling these calls, that's all you're going to get. But again, it's percentage of your holdings. It may be a decent percentage.
Yeah, that's true. I mean, it's a $72 stock, so $26 on a $72 stock is not a ton. But if you do that every week, 52 times a year, it starts to add up. Of course, you're not collecting that full $26. You're probably paying $7 ticket charge, $8 ticket charge, maybe 10. So figure you're making $15, $17, $18 on that. If you let it expire worthless, if you close it out, you're paying another ticket charge. So it's not a lot of money, you're right, but in aggregate, it could add up over time if your underlying stays still. So that's certainly something to keep in mind. But in general, you want to have at least a few hundred shares to really make it worth your while to do this on a regular basis, at least until the industry figures out how to price minis in a more reasonable fashion for guys like you. Next up is a question from Darren. Let's just say from Darren. He has a long handle here. He has a pretty basic one. Hi, do you guys have option alert services? And the answer, we get this a lot in some way, shape, or form on all the shows on our network. This one happened to come into Bootcamp. But the answer is, for us, at least on Insider, is no. We don't sell anything. We don't have any subscription services, at least right now. You can come to our site, get everything completely for free, including this show and every other show on our network. We do them all for free. You can get all the archived episodes. We have a lot of alerts we put up on our site, unusual activity alerts, breaking news headlines, things like that. So you can, of course, find all of those on the optionsinsider.com and listen to those and get a lot of value out of those. You can subscribe to getting them in various ways via RSS and stuff, but we don't have any services, quote unquote, that we charge for, at least right now. So there you go. You get it all for free, Darren. So enjoy it. All right. Another person along the same lines. This is Martin from Germany writing in. Says, thank you that you shared this precious information on your site for free. A great job. Well done, Martin from Germany. Well, thank you, Martin. And again, same note. All the stuff we do is free on the website, iTunes, Stitcher, wherever you find it. The Sogo folks put the show up on their site as well, sogotrade.com. A lot of great ways for you guys to find this stuff. And we try to put as few barriers in your way as possible. Try to make it free and open and easily accessible so all you guys out there can come in and really benefit from all these fun shows and all the fun stuff we have going on the old website. All right, next up, we have a question from a listener with a great handle, Tomabomb. He writes, first, huge fan. Second, question about the Wheel of Fun trade. Recently assigned on a short call and a collar position. Monday morning, I was long my protective put, a far out of the money leap, and decided to sell a weekly put that positioned me long about 25 delta. Now I'm wondering how this will affect my margin SMA. From the margin perspective, is this a put spread? Is this a naked short put? After I put this on, I realized the margin was a bit fuzzy. Since I just rolled out of a covered call, I'm obviously cash secured, but I want to work this out before I find my foot in a bear trap. Thanks, guys. Nice hats. Well, thanks for the comments. We try to put our nice drill instructor hats on. They're very fancy. But John, this is the margin question. This is right up your alley. What do you have to say for our friend here, Mr. Tomabomb?
I mean, the way I look at this question is the customer, after everything is said and done, is going to have a put spread on and naked stock. Now, we have our new optimizer, which I helped develop and took us a few years. So that we think that it's pretty robust, and it will optimize. It'll pair off things in the best way, the most advantageous way for a customer. So I think looking at this, the customer was assigned a short call, so now he's naked stock, and with the long put, he then sold the put. So that's a put spread, and we would optimize it that way. So I think actually, for Sogo Trade at least, the margin shouldn't be that fuzzy. It should be pretty clear cut. Also, when the customer on our platform, when the customer tries to do a trade on the trade ticket, we actually have a section that says the option buying power released or required, so the customer can see, or we give you the final number, can see the calculations of how much each trade is being, how much buying power is being consumed by each trade.
I will say this, John, what you guys do over there at Sogo Trade and what you do on this show as well, really putting an emphasis on margin, I really appreciate that. I think a lot of our listeners do too, because people come to the show, they want to learn about options, they start wrapping their teeth around the basics, what's a call, what's a put, direction, delta, Greeks, all that kind of stuff. And they start getting a little bit more advanced, start asking about strategies, but eventually there comes a time for all of them when they start realizing that, as our friend here says, margin in the options world is a bit of a fuzzy thing. And it varies by broker, and it varies how it's calculated, and it could really dramatically impact how you trade and the returns on your account. So all of them eventually come around to questions like this about margin. So I'm very glad to see that you guys at Sogo are putting margin really front and center and making a tool to make it less fuzzy for the end user. Because if there's one refrain we hear over and over again that I see far too few broker dealers really doing anything about, it is this. It is the lack of transparency around margin. So if you guys are doing anything to really make this clear for the end user, I think that's a great thing. So there you go, Mr. Tom Baum. If you have questions, contact John or head on over to sogotrade.com. All right. Next up, we have a question from a listener, Joss Soul, and he writes, this is a question for Bootcamp. How can you tell if implied volatility is cheap or expensive for an option? I assume from listening to the show that a higher volatility means the time component of the option's price is more expensive compared to an option with a lower implied volatility. But comparing the December 27, this is one of the ones that got caught up in our comment system snafu, so it's from a few months ago, actually, which is why I want to make sure I surface it here on the show. But comparing the December 27 at-the-money calls for Pandora versus Apple, that does not seem to be the case. For example, Pandora has an implied volatility of 113.6% and the time value of $2.57. And Apple has an implied volatility of 23.8% and a time value of $10.84. Since Pandora has a much higher implied volatility, why is the time value lower compared to Apple? I assume the answer lies in the Greek's vega, because P has a vega of 0.02, Apple has a vega of 0.48, but I am not sure. So is vega how you can tell if an option is cheap or expensive? I love the show. Please keep up the good work. Thanks. Well, you're kind of a little bit on the right track, but the answer is a little bit more straightforward than you made it out there, Joss. Remember, we're talking about implied volatility here. That's what we're talking about when an option is cheap or expensive. But what makes that implied volatility cheap or expensive is not the net amount of time value like you're talking about. It's really how that implied volatility level compares historically to the term structure and the skew in that individual name. So if a name is routinely at a 50 implied volatility across the board, front month, 3 months out, what have you, and all of a sudden it spikes up to 110, that's expensive from an historical perspective, and that's something you should be aware of, versus just saying this option has $10 of time premium, this option has $2 of time premium. This kind of apples and oranges, because remember the underlying you're comparing Apple, which is a nearly $600 stock, versus Pandora, which is, I believe, is about $27 right now. So volatility is, again, a percentage of underlying movement. It doesn't matter how high that percentage gets in Pandora. A $27 stock can only move so far, hence the lower time value versus the Apple option, which can move quite a bit. 10% move in that name is roughly $60 versus the 10% move in Pandora is $2.70. So you see from a percentage wise why one is much higher than the other. You can have much higher movements, much higher fluctuations in that Apple name, regardless of the actual level of implied volatility. So when we talk about things are expensive versus cheap, we really mean versus the historical, the realized vol that name has exhibited over time. There's a lot of ways you can evaluate that for yourself. I think there's a great tool out there called volatility cones. Just search for that. A lot of sites will have that for you. You can type in the underlying you're looking at, and it will show you the implied volatility range that is trading right now, how that compares to historical. A lot of the brokers will do this for you too, as well as a lot of the scanning tools, like we mentioned before, will help you do this. And you could see from just a pure mean reversion perspective where that vol stacks up, and that could help you form your own opinion about whether vol is cheap or expensive. Remember, at the end of the day, it's a subjective thing. There's no that vol is cheap, that vol is expensive. It really depends on your viewpoint, what you think about the underlying, what's gone on historically in that name. So to answer your question, no, it's not the vega. It's not the net amount of time premium that you're seeing lumped into that option. It really is just a question of the implied vol versus norms. And what you're talking about here is really just a $27 stock versus a $600 stock. So that's why one has so much more time premium lumped in than the other. John, anything to add here for our friend Mr. Soul?
Yeah, I just wanted to add one little thing, and Mark hit on it, but I want to reiterate it. It's a percentage move. And when you have a $500 stock, a 1% move is $50. You have to be very careful when you're looking at these numbers and saying, well, this is cheaper, this is expensive. We get questions all the time. The implied volatility of IBM is 22. What does that mean? And we've gone over this in the past. Basically, if you look at it, the way that the implied volatility, the Black-Scholes or the models that create the implied volatility numbers is that they look at the standard deviation of a stock, and then they multiply the standard deviation by the square root of the number of trading days in a year, or approximately 15.87. Okay, that's a square root of 252, and that will give you annualized volatility. This may all sound confusing, but I, as a trader from day one until now, I use the 16% number as about 1%. So if you see implied volatility of an underlying of an option is at 16%, the marketplace is telling that stock should move approximately 1% a day, you know. And if you see a 2%, that's why you'll see these high flying stocks that have these crazy high volatilities. But guess what? They're moving 3% a day. So, I mean, that's the way to look at it. Don't look at the actual premium numbers, okay? Look at the implied volatility versus historical and where the underlying is moving.
All right, we have time for about one more here on the old program. We got a listener who wrote in with a bunch of questions. I love you guys write in. I love that you're enthusiastic. Try to keep it to one, maybe two questions. But this guy wrote in with a bunch. We'll see if we can get to at least one of them. He's been waiting for a while here. This is a question from John B. He writes, where do I submit options questions in the tweets that you guys read on your podcast? Is this the place to submit questions? Here are my questions. Well, yes, you obviously found the right spot there, John, so don't worry about that. Part one of his question. I recently stopped trading Priceline options because the spread ranges from $2 to $4. Is this to deter traders, and why would the market makers keep the spread so high? This is a common refrain. We touched on it on the show in the past. We all were market makers at one time here on the show, so we have a bit of a unique perspective on this. And we hear this a lot. The market makers are screwing the little guy. They're screwing the little guy. They're screwing the little guy. This is an easy thing to fall back on when you're not really sure what's going on out in the underlying. But Priceline is a good example of a name like we were just talking about. Pretty volatile. We're not talking a $27 Pandora. That today, as of this recording, Priceline is trading $1,215. So remember, this thing could move around quite a bit. A 10% move is over $100 in this name. So if you're a market maker or a trader or any sort of really customer in this name, you're going to want to be a little bit wider just from a risk mitigation perspective. Remember, at the end of the day, these spreads are risk. They entail risk on the part of the people who are putting out these bids and offers. And so a name that's a little smaller or a lot of liquidity in it, you can make that spread a little bit tighter versus a name that's pretty big, that's got a lot of swings, exhibiting a lot of vol. You're going to want to back that up a little bit in order so you don't get run over. It's not realistic to expect a penny-wide market in a name that is trading $1,200. Let me just look right now. I'll get some current quotes here, and he's exaggerating a little bit. I'm looking at the monies right now in Priceline, and they're trading at about 80 to 90 cents wide. So if you come in the middle of that, you can expect to maybe carp that by like 40 cents and come in, split it down the middle, and maybe you get filled. Maybe you go a little bit one direction or the other. Maybe you're talking 50, 60 cents. So not an unrealistic expectation for a name that is as high-flying and as volatile as this. Now, granted, that's front month at the money. You start going a little bit farther out, those spreads are going to widen out a little bit as the liquidity dries up. You start getting farther away from the at-the-money strike, they're going to widen out a little bit. So it is entirely possible you could find some far month out-of-the-money strike that is $2 wide. Again, that's as a result of the liquidity. You see a spread like that, you come in the middle, and then you work it a little bit, and maybe you get filled for maybe 60 or 80 cents versus the $2 spread that you're seeing in there. But again, these things reflect the volatility, they reflect the liquidity. People are taking risk to make these markets. Again, this may actually filter back some of those complaints we see about HFT ruining the markets. There certainly is a case to be made for that, but in a name like this, a big high flyer, moves around a lot, very volatile, not exactly conducive to a lot of HFT guys coming in here. So you're not seeing a lot of those smaller orders that are in there and actually giving the illusion of a tighter spread. So you're probably seeing a more accurate spread for what the real market is out here, and as a result, it's a little bit wider. So high flying name, high volatility, you should expect it to be a little bit wider than a $10 stock that has a 15% implied volatility.
Can I mention one thing about this, Mark? You know, just remember, folks, the market makers that I was and Mark was and Dan was, they have to hedge. When you come in to buy something, they have to, or they should, they have to hedge that. And if you look at the price line underlying, it could be very wide also, and might not be that liquid. So you buy 10 calls, and the delta's 50, they're gonna have to hedge, 500 shares, and that it may be way away from the market. So with most big names, the markets are pretty darn good. And remember, as you go farther out, like a year from now or 6 months, these high price options, there's a lot of vega in these options too. So if the market maker buys or sells an option, they're taking on a lot of vega risk. So that's another reason why the market is so wide. And also, as we mentioned many times in the past, when you have a wide market like that, okay, try, as Mark said, but I'm going to say it again, try to, split the baby, go in the middle, and if you don't get filled, go up a little bit, and most times, 9 out of 10 times, I bet you'll get filled at some reasonable price. Don't put a market order in unless you absolutely, positively have to do it, because then you're going to get filled at a bad price. So let's try to get a better price, and most of the times you will.
All right, that's unfortunately all the time we have for the mail block for this episode. It's also all the time we have for this episode of Options Bootcamp. Again, I love you guys writing in. We've made as many ways as possible for you guys to get in touch with this show. You can, of course, surf on over to the website, post your comments and questions on the show notes there on pretty much any article, and we'll route it to this show. You can hit us up on email, questions@theoptionsinsider.com, Twitter or Facebook, twitter.com/options, facebook.com/theoptionsinsider, and, of course, our brand spanking new app. A lot of you guys choosing to use that way as well. So a lot of ways for you guys to get in touch with us. Make your questions and comments known here on the show, and we'll have to do one of these roundups again very soon, as well as try to filter in more questions on the show on a regular basis, because you guys are writing in with such great comments and questions. Keep them coming. But now, John, really quickly, why don't you let our listeners know what's cooking, what's coming down the pike in the land known as SogoTrade.com.
We're in the tail end of our mobile app being released. That should be good news, and I want everyone to come sign up for this advanced screen, which I've been using, which is great stuff. And, anytime any customer wants to send me an email or send it to service@sogotrade.com, they'll forward it to me. I'm willing to respond and talk to customers. That's what we're here for, and we love to help the customer.
Making a foray into the exciting world of mobile apps. I know a thing or two about that, so it's very fun. You'll enjoy it.
It's been a long time coming. I mean, this is a way to go, and we need to have it. We have a mobile a way our customers can link via their mobile device, but not an actual full-fledged app. So that's exciting that we're going to get that. So we're looking forward to it.
All right, and Dan couldn't make it today, but I'll give him a little bit of a plug anyway. If you want to learn more about what he's working on, check out one of his classes or his elite community, surf on over to markettaker.com. And on behalf of Dan and John, and of course myself, I want to thank all of you out there in the listening audience for downloading, streaming, checking out our app, and of course, sending in such great questions. Keep them coming, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.